So yeah, I was basically working in wealth management for my whole career. And wealth management is an industry that very few people know or understand because it's very exclusive. So I used to manage money for 2 million or more of investable assets types clients. And when you're managing money for large clients like that, you're not just doing the investments, you're doing financial planning, tax, and estate as well. And it's all nicely integrated together by like a team of lawyers and accountants and planners and portfolio managers all working as one. So it's a really nice service. It's really easy for the client, cost efficient, but the way that it's delivered is very manual and therefore very exclusive. And so this business that I started up about 3.5 years ago is effectively wealth management, but heavily automated so we can bring the cost down and deliver it to middle-class people. That's the concept, right? And the integration makes sense. I'll kind of go through stuff. It'll make more sense as to why everything should be considered together. But for instance, depending on what your tax bracket is today versus in the future is how you'll decide if you want to put money in an RSP or a TFSA, for an example, right? And so there's a tax piece kind of coming together with a financial piece and an investment piece. So they're all interrelated. It makes sense to kind of look at it as a whole. It just hasn't been historically possible because it was too time consuming to do it. So technology helps us out there. This is kind of what I do, but today we're not going to talk about, what I offer as a service primarily. We're going to try to just provide some education, some financial wellness and literacy. That's the idea.
Keep going, I'm just going to bring some of the video.
Okay, all right. So basically, that's just my title, and so I started a company. I'm a CFA, chartered financial analyst. Okay. Yeah. So why wealth management? So why, I guess, should you be paying attention? You should pay attention because it could be the difference between retiring early and not retiring at all. Wealth management is something that adds a little bit of value consistently every year, and it really adds up over time. So this is forward-looking based on current growth rate projections and interest rates, how a mutual fund investor will do net of taxes and fees, how an index fund will do net of taxes and fees, and how somebody who follows all the various things that we're going to go over today would do over time. Okay, so it's important. So try your best to stick with me. But before we start, I kind of want to gauge people's knowledge so that I don't go too technical or too simple. So maybe just by show of hands, how many people here would consider themselves like average financial knowledge? Not average. Yeah. Any below average? Nobody wants to admit it. Anyone above average thinks that they know?
Well, I know a little bit.
Okay.
Yeah.
All right, that's fine. So you might have noticed that I wasn't actually gauging your competence. I was gauging your confidence. How confident are you that you know what you're doing? But that's not the same thing as competence. And there's a lot of studies where they ask people, are you a good driver? And then they test you. And then they basically chart how those two correlate over time. So this is called the Dunning-Kruger effect, and it takes place in lots of different industries. Basically, if I were to ask you to fly a plane, the pilot just had a heart attack, I need somebody to fly this plane, I think most people, unless you're a pilot, would correctly know to say, I have no confidence and no competence to fly this plane, and you'd be right. The problem is when people gain a little bit of competence, suddenly they're an expert, Everybody knows that person, right? Who just read an article and now they're an expert. I think it's best exemplified by this amazing quote. Nobody knew that healthcare could be so complicated. Well, some people did, but they generally had more competence than those who didn't. So the idea here is I'm not trying to slam anybody or anything like that. What we're trying to do is move people up this curve, okay? This is the most dangerous place to be as an investor. When you lack the competence, but you think you know everything. Those are the worst investors. These are actually some of the best investors here. right? So some of the people who said below average might actually be a lot more competent than they think they are, right? We're just trying to move people up this curve, right? Because it just makes you a better investor, all right? So this topic is basically behavioral finance, okay? And it's important to kind of understand it because most of what causes us to be bad long-term investors is psychological, cognitive, emotional factors that negatively impact our decision-making. So these are some various behavioral finance issues that cause us to be bad investors. Overconfidence. We think we're smarter than everyone else. That's not a good thing as an investor. Bandwagon effect. We all know this. Bitcoin, marijuana, you name it. There's always a bubble out there. And primarily it starts maybe for a good reason, but pretty soon people are piling in just because everybody's getting into it and it's making money, and so I'm going to join into, right? Loss aversion, the concept there being, okay, I bought something at $10 and I don't want to, it's gone down, but I don't want to sell it until I at least break even. That's loss aversion. Confirmation bias, you're going to search and put more weight on information that confirms your pre-existing ideas. Hindsight bias, the past seems way more predictable than it actually is. A lot of people will look back at the financial crisis and say, next time the markets sell off 40%, I'm going to be buying hand over fist. Well, you can only say that with hindsight. At the time, a lot of people, said that basically the market was going to go to zero and the world was going to implode. That obviously didn't happen, but it's a lot easier to look in hindsight and think that things are easy to predict. Here's another interesting study. So basically, women are better investors than men. The reason for that is because women are less susceptible to these biases than men, primarily overconfidence. Overconfidence is more prevalent amongst men and something that really hurts our performance. So let's talk. Yeah. We'll kind of see why as I put the pieces together for you. So here's another really interesting behavioral bias. It's called action bias. So they did a study of soccer goalies, okay, during penalty kicks. And if you're a goalie, you can either, stand there, you can dive left, or you can dive right. And they measured what percentage of the time the goalie was doing those things. So 94% of the time, they're diving one way or the other, right? And 6% of the time, they're standing still. Then they measured what percentage of the time do the penalty kickers kick in each quadrant, or third, right? So it's a third, a third, a third. And effectively what it means is that if you are a soccer goalie, you are best off standing still. You will stop more shots standing still than diving. But when everybody's in a stadium screaming at you to do something, you want to make it look like you made an effort, right? That's what action bias is. And investing is actually the same. Most people with investing, markets move, and they move all the time, and you think, I got to do something, right? It's going up, I got to sell, it's going down, I got to buy, or whatever it is that you think you got to do, but you got to do something. You got to make an effort. In fact, just like the soccer goalie, you're generally better off doing nothing and just holding, okay? So that's what action bias does. There's another great study of this. It was done by Fidelity. Fidelity is a large investment manager, and they looked at all their retail accounts. So these are accounts that are managed by individual investors, not investment professionals. And they were trying to say, well, let's break them out into the top performers and the worst performers and try and figure out what characteristics are common amongst the top performing accounts that we can maybe replicate, right? And so they found that consistently the top 2 performing groups had 2 characteristics, one or the other. First was dead people. Because if you're dead, you don't trade your account, you hold it. And that's going to result in better performance. The second category, people who forgot they had an account at Fidelity, right? Again, if you don't know the account's there, you're not trading your account, you're just holding it, you're going to be a better investor. So action bias is pretty funny. I got one more good story for you. This is about becoming a probability-based investor. So we can all laugh at how stupid these biases are, but we're all susceptible to them. I'm no different. I'm susceptible to these things as well. And so what do you do about it? Well, basically you want to become a probability-based investor. What things work statistically on average, I'm going to do those things. So there's one more good story to tell you about this. So Paul D. Podesta wrote Moneyball, and he tells this story about this person who's at a blackjack table, and he's having a really rough night, probably having too many of the free drinks, because every 10 minutes he's going back to the ATM to get more money because he's just losing, and he gets dealt a 17. And at this point, the dealer kind of feels sorry for him. He's like, this poor guy's losing his shirt. And just kind of breezes over him, and the guy stops the dealer and says, no, I want to hit, like, hit me. Are you sure? Like, sir, you... Yeah. All right, he wants a hit, so he gets hit, and it's a 4. 21. And the guy's, ecstatic, jumping around. I knew it, you're all idiots, And I think the best way to sum this up is a great quote from my friend Daniel Crosby. You can be right and still be a moron. So this is how investments work as well. You can get lucky. You can have a bad process and a good outcome and get lucky. You could have bought marijuana or a Bitcoin and just happened to sell at the right time. It's dumb luck in some cases. Sometimes you're the person who jumped on that bandwagon too long or too late, and you wrote it down, and that's kind of poetic justice. You didn't know what you were doing and you paid for it. What we want to do as investors is focus on having a good process, okay? It's not going to result in success every single time, right? But if you have a good process that works on average and you consistently employ it over time, it will work. The greatest example here is the house at the casino, It's the opposite of the gambler. The house has the odds in their favor. You play that game enough times, eventually they're going to win, right? But that doesn't mean you can't just get lucky every once in a while. So this person had a hit of dumb luck, but you look at the whole night and it was more poetic justice because they lost more than they won. So we want to be probability-based investors. How do we do that? Okay, it's all about process, right? So the first thing is to have a written, we call it an investment policy statement, but you can call it whatever you like. Write down exactly how you're going to invest your money and why, okay? And go back to that when markets get a little wild, right? Because that's the time when these biases are going to affect you more, is when things are crazy. You're going to be more irrational. So you want to write down what you're going to do, things like, what's the purpose of this? Am I saving for retirement? Am I saving for a house? What's my time frame, right? Other factors in there, a little bit about yourself, personal, professional, financial situation, how much money you're making, prioritizing whether or not you want to grow your investments or, maybe you're in retirement and you're living off the income of your investments. This is all kind of, I won't go into too much detail on it, but writing down your objectives, what you're going to do, why you're going to do it, and then following it in times of crisis is really important, okay? So we do it in an investment policy statement, but you can write it down anywhere. So part of that investment policy statement should include an asset allocation. How are you invested? So I don't want to go into too much detail here because, most of the people in the room are kind of average investment knowledge, and this can get a little complicated. So to simplify it, this is all about diversification, okay? We don't know what's going to happen in the future. We can't really predict when Donald Trump's going to tweet and blow somebody up. So we want to diversify because we can't predict the future, and by owning lots of different investments that have different characteristics, different risk exposures, different return profiles, we are hedging our bets, so to speak, and reducing the overall risk of the portfolio. So diversification is key. Cash, bonds, stocks are the most common types of investments. Those should be a portion of every client's portfolio. In the current environment, interest rates are very low, so there are some additional asset classes that we recommend adding into a portfolio today, like high yield bonds, preferreds, senior loans, mortgages. Again, gets very technical and I don't want to go overboard here, but if you want to learn more, I'll provide everyone with a guide at the end of this. It's like a 24-page, goes into detail. So if you are so inclined, you can go into that. But if you're not so inclined, just take this. You want to diversify. Don't put all your eggs in one basket. Lots of different types of investments. That way you're protected in any eventuality. Okay? Active versus passive. This kind of comes into play based on the whole behavioral overconfidence action bias. So why is overconfidence and action bias bad for you? Because you're probably going to be an active investor. What an active investor means is that you're spending your time trying to pick stocks or time the market. You're going to say, I think Suncor is going to outperform Imperial Oil. You might be right, but in order to make that trade and buy Suncor, somebody needs to sell you their shares in Suncor, right? So one person's buying, one person's selling, one person might be a winner, one person's going to be a loser. You don't really know at the time, but time will tell. And so it's kind of a zero-sum game. For every winner, there's a loser in active management. The reason why it's bad on average is because there's this divide between the buyer and the seller that is made up of fees. Okay, so in the middle of all these people trading their accounts is fees. Average mutual fund fees in Canada are 2.2%. That's the highest in the developed world, and it's because of all these different costs. Salaries of salespeople, portfolio managers, analysts, the firms, the brick and mortar, all that sort of stuff. The costs add up, and so the average return of all these active managers is the market return less all of these fees, right? And so the best thing you can do as an investor is basically cut out all of those fees and invest passively in the index, okay? Picking stocks is a zero-sum game, and the best thing you can do is to own all of them at low cost. Does that make sense? Okay. It's not just something that makes sense. We can look historically, and the statistics back us up. So this is a scorecard. It's called the S&P Index versus Average scorecard. It's as of the end of 2018. If we look at one-year numbers, basically active managers underperform their benchmark 60, 70, 80% of the time. So most of the time, but it's not significant. You can win in a one-year time frame because, you know, you might get lucky, right? You might be that person who hit on 17, right? You can get lucky and you can outperform, but most people underperform. And the longer the time frame we look at, the worse it gets for the active manager, right? Over 15 years, 90% of all active managers in any asset class underperform, right? Because it's very difficult for them to consistently pick winning stocks net of all the fees they're charging, right? So you're much better off just buying the index, which is to say all of the stocks, right? So don't just pick Suncor versus Imperial, you own all of the companies in Canada, as an example, okay? So a little bit more about it, 90% underperform over 15 years. I mean, it looks even pretty bad after 3 years, 80%, 5 years. It's not good odds.
Question. Is
Sure.
this speaking specifically if somebody else is managing like your portfolio?
Yes, yeah, you're paying somebody to manage your portfolio. This is their performance against the benchmark net of all costs.
Do you have any data on like retail investors comparative? I imagine it's probably worse than this.
I don't, but it is, and the reason for that is primarily that you account for the flows of money. So this performance is bad, obviously. This is people who are invested in a fund, which is good because at least they're invested throughout the whole cycle, right? They're not, panicking and selling in 2008 and getting really greedy and buying, in 2007. This is just the fund throughout, ignoring the flows. When you add in flows, so retail investors, we tend to panic at market bottoms and sell, and we get greedy on market tops and we buy. If you factor that in, drags down performance a couple more percent, depending on the study. So yeah, it's even worse.
So just to clarify, retail investor is us going through Equitrade or whatever,
Yes.
Equitrade and buying and selling stocks and playing
Yeah,
the
that's right.
romantic game of
That's exactly right. Yeah, the average person managing their own money does very poorly. And the other side of that is that, I mentioned that active management is a zero-sum game. So when retail investors perform poorly, somebody's outperforming, right?
Yeah.
Institutional investors are, actually. So the processes that I'm talking about here, having targets to asset classes, right? And I'll get into a little other things later, are the things that kind of benefit from the ill-informed,
Yeah.
okay? So we follow a process that means that when other people are panicking, we're buying. And when other people are greedy, we're selling. Not because we're smarter than everyone else, simply because we follow a process. And the process works on average over time, right? And so by following consistently, we add consistent value.
But from what you're saying, even just by following that process,
The institutional investors,
These
net of,
mutual funds and like fund managers,
yeah.
But
but not institutional.
won't institutions be
Institutional,
under active management as well?
they would, but generally they're firms like pension funds, endowments, foundations, high net worth clients. So these are much larger pools of assets, and because they're really big pools of assets, they actually pay very low fees. For instance, I used to be a manager, right? I manage 3 billion in assets. If you get, a pension fund with 500 million, you don't have to charge them a high percentage and make a lot of nominal fees, right? So the scale, it's economies of scale of pension and institutional investors allows them to invest at a low cost. Retail investors don't have that scale. We're smaller, and so we end up kind of getting gouged by, banks and brokers and those sorts of things. Yeah, so our fees are a lot higher. Yeah. And we don't have as good of a process, and we're more emotional, and all these problems compound against us. Yeah. So impact of fees. So this just shows you if you were to invest $100,000 and you were to earn 7%, which is a reasonable rate of return for a stock investor over a long period of time, you would return all the way up here. Okay, so your 100,000 turns into about 700,000 over 30 years. Okay. However, the average mutual fund investor pays 2.2% in fees. So if you get an index or market return of 7, and then you subtract the fees, your average performance is 4.8, and this is what 4.8 compounded over 30 years gets you. Effectively, just over half of your money goes to the bank in the form of fees. Okay, so that's why fees really matter. 2.2% is not half of 7, so it might be surprising, but when you compound it over time, it works against you exponentially. Okay, so fees are really, really important. If you want to know what the most highly correlated factor of future performance is, it is fees. You want to pick the best fund out there, pick the lowest fee fund.
Yeah.
Okay. So
What would a bank traditionally? What is the bank?
2.2 is the average. Yeah.
And then ETFs, would they just have basically a fee factored into the
Yeah, so an ETF is generally indexed, so they're just buying all the stocks in Canada or all the stocks in the US, the index they're following, and because they're not bothering to analyze the companies and try and pick the winners, it's very formulaic, right? So they just buy everything, and the administrative cost is kind of the only cost. So it might charge about 0.5%, or anywhere from 0.05 to 0.5%. Which compared to the 2.2 is very, very cheap. Yeah.
And so most people aren't there isn't actually really teams analyzing, and most of them are just indexed funds. Like when you do more of an ETF, or is there are other ETFs that have more active management or more management with them, I guess.
Sorry, what the beginning of that question was?
So I guess clarifying, you're saying that most of the ETFs are mainly indexed. There's not really any.
Most of them.
Yeah.
Yeah, there are some active. So again, it can get a little complicated if I say all mutual fund are bad and all ETFs are good.
Yeah.
It's not entirely the case, because you can get an indexed mutual fund and you can get an active ETF,
Yeah.
right? So at the end of the day,
No.
to try to make it as easy as possible, I'll simply say this: focus on the total amount of fees you're paying.
Yeah.
Regardless of it being a mutual fund or an ETF or whatever, it's the fees that matter the most, and that's what you want to focus on. ETFs tend to have lower fees, but not always. Okay? So the reason I put up this historical return is another problem people have is that they're not always in the market, right? So as I mentioned, retail investors are more likely to let their emotions take over and kind of try and time the market and panic at the bottom and things like that. This should give you some confidence to basically put your money in the market and hold it. Okay? This goes from 1996 until 2019. And we look at how has a balanced portfolio, one of them is kind of 60-40 balanced, and a more aggressive and a more conservative option. How have they performed over that 24-year period? And what you'll see is that pretty much it always moves in the right direction. Now, obviously you will have corrections, but they kind of just look like little blips when you look at them through history, right? And so despite this, a lot of people might say, well, the past is the past. It was easy, right? Like back then. And it's hard today to determine what's going to happen in the future. Well, it wasn't actually that easy. Here's some examples of events that happened, some big events, and how it affected performance. Okay? So you might have thought, oh God, the US invaded Iraq, I'm out, right? War is going to break out. Well, you would have been better investing. You might have thought, oh, the US market peaked, I'm going to get out. And unless you happen to time it extremely well, you'd probably be better off staying invested, right? Asian financial crisis, tech bubble, fiscal cliffs, EU crisis that we had. All of these things, despite them feeling like very bad times to invest, turned out to be good times to invest, right? Markets on average go up over time, and the best thing you can do is stay invested, okay? Because you can't predict when these are going to happen. They're very difficult to time, and all these headlines, you know, which might seem bad, don't actually matter that much, okay?
It's interesting, the downtimes are not that long, while the
The
Yes.
gold
side
periods,
is long,
Hmm.
and then the recovery is about maybe 2-3 years, and it gets back to that
Yes.
point.
Yeah, that's a very good point. So, you know, if you were to just hold for a year or two, you would have broke even during the worst financial crisis since the Great Depression, right? So,
And
But-
if you're actually adding more money, then you'd have made even more.
yeah, recessions are good if you're consistently adding money because you're buying shares at cheaper prices,
Yeah.
right? But the point is, they dip. It's hard to time. The best thing to do is stay invested. I will also state that this is a diversified portfolio, right? So this blip isn't that big, partly because you own, you know, a dozen different types of investments here, and that's helping you. Whereas if this was just a stock, it would have got cut pretty much in half, top to bottom. Now, if you would have held it for 2 years, you still would have recovered those gains, but it would have been harder to do because when you lose half of your money, those same behavioral biases are more likely to come into play, right? Because you lose more money, you're going to panic more, right? Because it's, yeah. So anyways, we want to stay invested for the long term. It almost always works in our favor. Here's another interesting thing. So stocks versus bonds. Okay, so to briefly explain them, stocks is a higher risk investment. It's when you own a portion of a company and you get paid based on how much the company makes, right? A bond, on the other hand, is basically you lend money to a company and they pay you interest, okay? Bonds are generally very low risk and pay low returns. Stocks are higher risk and pay higher returns. But the problem is that that's really only a true statement over short periods of time. Because if we look at stocks, you know, it can be great, it can be terrible, it can be anywhere in between, versus bonds, you know, worst case scenario, it doesn't even lose 10%, you know. So that's a true statement. Bonds are less risky than stocks over the short term. But look at what happens over 20 years. Over 20 years, the fact that stocks give you higher average returns basically more than makes up for the additional movement in the price of them. Okay? So over 20 years, stocks offered investors higher returns and less risk. So time horizon matters a lot. All right? And so if you're looking to invest for 20 years, which I would argue most of the people in this room probably are, stocks is going to be a better investment for you. You may have kind of heard the term that when you're young, you want to invest in higher risk stuff, and then as you get older, you want to reduce the risk. This is why, right? If you're on the flip side of this and you're a 70-year-old retiree, you can't afford to lose 40% in a year, right? You don't have time to recover. So that's why you're lower risk when you're older and you're higher risk when you're younger, okay?
So how would you then cross-reference this with how volatile our current market is with different companies going under that have been around for so many years and all these startup companies that may not last, you know, 25, 30 years?
Right. Well, I would say that's part of the reason why you diversify, right? So picking individual stocks, you might get lucky and pick the Amazon. You might get unlucky and pick Staples or whatever, you know, Blockbuster. So
You're already pronouncing the death of Staples.
I don't know. We'll see. Maybe that'll age poorly, and 100 years from now, Staples will be the biggest
They're
company.
bigger than Amazon.
Yeah.
Their
We'll see.
printing online services are very convenient.
Maybe
Anyways,
one we don't know.
So picking an individual stock does expose you to more of that risk that a company just goes under. That's why you index. So when you own the Canadian stock market index, you've got 250 plus companies in there. The fate of one or two companies isn't going to matter that much for you, right? So diversification reduces risk. The whole idea being don't put all your eggs in one basket. You need to diversify. Yeah. So moving on to interest rates. So again, I don't want to get super technical here, but it is an important thing to understand. If you invest in bonds, which are the lower risk investment, your main determinant of future returns is the interest paid on the bond, okay? And this is how much interest was paid on global governmental bond yields over the last, 94 until now, so 26 years, okay? So basically we see interest rates going down, 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 down until where they are today, where if you invest in bonds, you're getting paid 2 to 2.5%, okay? So bonds pay interest. You don't get any portion of the company's profitability. So if you buy a bond that pays you 2.5%, that's your return, okay? It can't possibly be better than that because they're just paying you 2.5%. And even if they become hugely profitable and do very well, you don't get a share of that, right? So 2.5% is what you get paid. The downside is you can get less if the company goes bankrupt, then they don't pay their debts. Or the other way is that if interest rates go up. Okay, so if I buy a bond today at 2.5% and interest rates go to 3.5%, then nobody wants my bond because it only pays 2.5 and I can go to the market and get 3.5, right? So the only way I can sell mine is if I sell it at a discount. Okay, so when interest rates go up, bond prices go down.
So
Right.
on that, if you're picking, so if you have a bond and say it's like a 5-year bond,
Okay.
and then at the 5-year, they're like you're not selling that because like the bond is just up, right? So
Sure.
you've recouped your 2.5%.
Yeah, you'll get
need
2.5.
to sell it, right? Because it's basically if you want
Yes.
to leave that bond early, then you need to.
Yes, if you buy it and hold it to maturity, your return is the interest rate on the bond. Yeah. But in the short term, the price will move because if interest rates go up, nobody wants yours, so yours gets a discount. Given this trend, it's very hard to say when it's going to reverse, but I like this quote to explain what might happen with bond yields going forward is when you hit rock bottom, the only way to go is up. We could go negative. We've seen actually in Germany and Japan, they have negative interest rates right now.
So how does that?
Effectively, somebody is let's say I have money and I want to give it to the bank. I have to pay the bank money to hold my money. It's a really weird concept that I don't think we're going to have long term, but again, hard to predict what happens with the market, and that's why we diversify, right? But on average, if I look at this and I'm owning an asset that pays me 2.5% and interest rates are more likely to go up than down, it doesn't seem to be the most compelling asset to own, in my opinion. And so that's why you would want to diversify into some of those alternative income sources I talked about, preferred shares, high yield bonds, senior loans, mortgages. They all offer about triple the rate of interest as you would get on a bond, and less interest rate sensitivity. The flip side is there's no free lunch in investing. So if it was that simple and I could just make more money and not take risk, everyone would own it. There is more credit risk with them, right?
Yeah.
These are companies that are less financially secure and therefore could, with a higher probability, default on that debt. However, at least you're being compensated for the risk you're taking. Our opinion of bonds right now is that you're not being compensated for the risk at all. You're basically making inflation and you're taking risk with interest rates, right? So not the most attractive asset right now. You would still want to own a piece of it because you never know what's going to happen. But to have a good chunk of your portfolio in this would really drag down your performance. And so that's why we own some alternates. What's the benefit of those alternates? Well, when we factor it all in, this is an optimized, balanced portfolio that we manage with alternative sources of income. We have a higher weight in emerging markets, which have higher growth opportunities, better demographic trends. The result is that we can basically boost return without adding additional risk, right? Because we're able to diversify amongst more asset classes, which reduces the risk, and then get higher interest rates and higher growth rates effectively. So there's a lot of numbers that go into this. Happy to go over that in more detail if people are interested. But for now, I will move on to this fun little chart. It's called an asset allocation quilt. so it looks very complicated. I'll just kind of walk you through it. For each year, this shows how these 11 asset classes have performed, okay? So what's interesting is something like this. This is emerging markets. 2007, top performing asset class. 2008, worst performing asset class. 2009, best performing asset class, okay? That's not always the case, but if you do look at it, you'll generally notice that things that are top performers might do that for a short period of time and then become worse performers, right? Things tend to fluctuate. Whatever's in favor does not remain in favor forever. Whatever's out of favor does not remain out of favor forever. Things go in waves and cycles. And so it might seem like, hey, if only I could just buy these asset classes and not on these asset classes, I'd be rich. And you're right, but it's impossible to know which is going to be the best performer in advance. We can only know with hindsight. But there is one way that we can, on average, own more of these and less of these. And that is the next topic. So, rebalancing. When we started off, we had an asset target. So we had it's a portfolio target. So we're going to own 10% in US stocks, 10% in international stocks, 10% in Canadian bonds, whatever it is. We've set our targets. If you rebalance to your targets, you are forcing yourself to buy low, sell high, right? Because if I own, say, US stocks have been a great performing asset class for the number of years now, then it's going to be over my target because the value of US stocks has risen. So it's over my target now. If my process is to rebalance back to my target, I am forcing myself to sell US stocks and I'm buying things that have not done well, like emerging markets have actually underperformed for a period of time now. So I'm forcing myself to sell US and buy emerging markets. That is how you buy low, sell high. You set a process because no one's going to want to do this. When something is doing well, our herding bias kicks in. We want to own it. We think it's going to keep going. So you basically force yourself to have some discipline. So rebalancing frequencies, we did analysis to determine how many times should you rebalance, right? How often should you rebalance? If we look at a portfolio over the last, I think this went back 24 years, and we look at how much we allow each asset class to deviate from their target before we rebalance, then the longer we allow it to deviate, the further from target, then basically the less we have to rebalance. So if we're rebalancing every 1% deviation, we're rebalancing all the time, once every quarter on average, right? That means lots of trade costs, taxes are going to be paid as opposed to deferred, and versus if we don't rebalance very often, we allow it to deviate a lot from its target, we almost never rebalance, okay? So probably want to pick something in the middle based on this analysis. There's a few other details. Risk versus return. So if I don't rebalance, so I'm allowing the portfolio to deviate up to 12% from its target, so I'm not rebalancing, risk becomes higher. The reason for that is if you don't rebalance, the highest growth investments, basically stocks, will take over the portfolio over time because they're going to accrue gains faster than the less risky assets, right? So they take over and the whole portfolio becomes riskier over time, okay? So probably don't want to leave it forever, but maybe again, somewhere in the middle makes a lot of sense. This next chart is kind of the meat of it. If we look at, again, how long we're allowing it to deviate from target and what our return is, we find that there's kind of a nice little bell curve here. So if we actually allow our target, our actual weight to deviate from target by 4%, we maximize our returns. Why is that? Why does that make any sense? Maybe this is just data mining, it's just a historical anomaly. Well, not really. The reason it makes sense is because markets are driven by momentum over short periods of time. Herding bias, right? Something that's done well in the recent past, we think is going to do well in the near future. And it does because we think it, and then we all pile into that market and we push the price up, right? So momentum carries markets over short periods of time. Mean reversion happens over long periods of time. So everyone's piling into this new thing that's great. Maybe it's Bitcoin, maybe it's marijuana, maybe the next one's tech stocks. It's hard to say, but everyone's piling into it. And then eventually we realize, well, this doesn't make a lot of sense. This is very expensive and something changes and all of a sudden that momentum flips and everybody's rushing to the exit, right? You want to get out before that happens, So on average, you want to rebalance at a point at which you allow momentum to carry over the short period of time, and you want mean reversion, you want to get out before that bubble pops. This happens to be the threshold that works on average. It's not going to work every time. Again, you're the house at the casino. You're not the gambler, right? Doesn't work every time. But if it works on average and you do it consistently, it will add value, right?
Yeah. So are you mapping your target like through time basically? So you're forecasting like December in 2021, this asset I'm targeting that'll be this. If at December 2021 it's a 4% deviation from that target is when you would take action. Is that sort of how to understand it?
No, so I'll simplify it into, let's say you have a portfolio with just 2 investments.
Yeah.
50% is bonds, 50% is stocks.
Yeah.
Okay? And we're in 2007, right? So the market's done very well. Your stocks are now probably overweight, right? So now they're at 55%. And that therefore my bonds are at 45.
Oh, so it's all
I'm gonna sell, yeah, it's relative to the whole portfolio.
Gotcha.
Yeah, so if my stocks are 55, I want to sell them to my target of 50. I do that and I buy bonds.
Yeah.
And then the market corrects 2008 and all of a sudden the situation's reversed. Bonds are overweight because they've done well. Stocks have done very poorly. They're underweight. I rebalance again to target. And then 2009, they reverse again. It's not always going to work out that perfectly, obviously, right? You're going to have markets like the last 10 years where we haven't seen major corrections. It's just been going the same direction for a long time. But on average, if you allow a 4% deviation from target, you get the momentum carry and you rebalance before those bubbles burst.
That makes sense. So it's obviously key why the asset, like your asset allocation mix is defined.
Yes, and then you write it down and you follow that process.
Right, yeah, principles. Yeah.
Yes, yeah. So the other thing it does is prevents excessive trading. If you're rebalancing all the time, you're trading your account, and guess what that means? Taxes, trade costs, and a lot of time, right? So it works out well because 1, it maximizes return, 2, it minimizes all those other things. So it's kind of the sweet spot. Combined taxes. So we'll talk briefly about taxes just in concept. There's a lot of different strategies that you can employ, but let's just talk about why we care. So most people understand that as you get more income, your taxes go up. This is your marginal tax bracket, okay? So if you're earning, let's say 50,000 and you're in this bracket, you earn an extra $1, you pay 30.5 cents in tax, okay? Most people are aware of that. If, however, you were to generate capital gains, so this would be in a taxable investment account, or it could be on a second property. Anytime you buy an asset and you sell it at a profit, you're paying half the tax bracket, okay? So more tax efficient than interest income. But the other thing is over here, almost nobody is aware of dividends. If you get paid a dividend from a Canadian company, that company is paying it with after-tax corporate profit, meaning the company's paid about 25%. Right? If they pay that dividend to me and I'm in, say, the 40,000 bracket and I'm supposed to be paying 25%, well, the company's already paid the tax, and if I were to pay additional tax, it would be double taxation. Okay? So the credit, you get a dividend tax credit that credits you, the end investor, for the taxes paid by the company, making your effective tax rate on a dividend 0 for that investor. Okay, so it's going to depend on your tax bracket, and these things will change over time. But if you understand the types of investments, the types of returns they generate, and your tax situation, you can structure things in a way to reduce your taxes. Okay, there's lots of different strategies here. Again, they get a little technical, so just focus on the basics. You want to reduce your taxes by reducing your income, smoothing your income, or deferring your income. That's what you do. There's strategies to do these things, but that's how you lower your taxes. Okay?
Do you go back to that?
Well, yeah, I can also send a copy of this at the end if you'd like. Yeah, and what I find more useful is the guide because it'll have this information as well as explanations, right? Because this without context is not as helpful. Yeah. Value of deferring capital gains. So the other thing people sometimes can do is if you own an investment and it's made money, you can decide, well, I'm not going to sell it because I don't want to pay taxes on it, right? It's called deferring your capital gain. Well, what is the value of that? basically we can look at it and say, hey, I've got a scenario. I bought something for 100,000. It's worth 150. I could sell it today, or I can delay for 5 years and just hold on to it and sell it 5 years later. What is the difference based on these two scenarios? Well, if I sell it today, I pay taxes, right? So that means I have less money invested for the next 5 years because I paid taxes to the government today, as opposed to this person who has not paid any taxes, right? So my money compounds over the next 5 years. I make a little bit more with delaying my gains because, well, I had more money in the market, right? Then I pay my taxes at the end, and the ending value net of all taxes, I've added $3,000 worth of value by deferring my gains for 5 years under those assumptions. Okay?
On that, so if you have an asset that is, say it's at your target price based off of your principles, and you like, but you, so are you delaying that? You're not actually selling that particular share, you're just holding it?
Yeah.
On the tail end of that, wouldn't there be some risk of essentially having that in the market then? Now it's hit your threshold, you want to sell that, lock in that profit.
Yeah.
Is there risk on that tail end?
Yeah. If we go back to the slide on the actual performance over here, this one is net of tax. So even though you can defer and reduce your taxes, there's a point at which you would still be better off paying the taxes and selling something that's gone up to buy something that's done poorly.
That makes sense.
So yeah, but that said, if all things being equal, you can avoid paying those gains, you should. And that's also a benefit of passive investing versus active. So when I am, let's skip ahead there. When I'm an active investor, I'm constantly trading my account because today I think Suncor is a good company and tomorrow I change my mind or whatever, right? I'm buying and selling, and so anytime I have to make money, I'm paying taxes. When you're a passive investor owning all the stocks in the index, you're basically deferring your gains by default, right? So it's a much more tax efficient way to manage money. Just being passive allows you to get this benefit. Yeah. Asset location. So this can get a little complicated. I'll tell you the basic purpose of it. When you're investing, you have your diversified portfolio with lots of different types of investments, right? Bonds, equities, whatever. Then you have lots of different types of accounts. You might have a TFSA, you might have an RRSP, you might have a taxable account. These accounts have different tax consequences, and these investments have different tax consequences. Asset location is simply the process of deciding which accounts should hold which assets. Okay? The simple way to think about it is this. TFSA versus RRSP. A TFSA and RRSP both feel tax-free because when you invest within them, any money you make, you don't pay any taxes, okay? But they're not. RRSPs are tax deferred. When you eventually take the money out of that account, it becomes taxable income, right? And so if I grow this account a lot, it means I'm going to have more taxable income in my future, which means more taxes. If I grow my TFSA a lot, no tax consequence, because anytime I take money out of my TFSA, it's tax-free, right? So I would ideally, based on those two types of accounts, want to own the investments that are more likely to perform well over long periods of time in the TFSA, as opposed to the RSP. So emerging markets, as an example, is the highest risk equity category, likely going to be the top performer for the next 20 years. I would prefer to own that in my TFSA, and I would own, say, US stocks, which have lower growth rates and less risk, in the RSP.
The reason for that is because any money that goes into your tax savings account, you've already paid taxes on.
Yes. Yeah. Versus the RSP, it's pre-tax.
And so any gains in the TFSA, you don't pay any capital gains.
It's all tax-free. It's all tax-free. Gains in here is also tax-free. It's just that the growth becomes income. Yeah, which results in taxes when you take it out. And then a taxable account, well, you want your most tax-efficient stuff in there. So remember, dividends for lower income earners is almost tax-free. That's a great thing to own in a taxable investment account. So that's the general concept, but basically different investments have different tax consequences. Different accounts have different tax consequences. Where the investments go is called asset location, and it's really a mathematical kind of solve for X types scenario.
So just curious. I saw an article talking about CRA going after people trading in the TFSA.
Okay.
So how does that affect things in general? I know you're a proponent for passive,
Hmm.
but
What were
I'm
they
just
going
curious.
after them for though?
Yeah.
I know like one thing, my dad, he figured out that he could swap assets from his RSP to his TFSA. At the time, there was no rules against it, but then CRA looked into it since it was such a tax effective strategy. They actually
Right.
ended up going and reclaiming those taxes because they put a rule in place that year or whatever, and they're like, well, for the last 5 years you've been doing this, now we owe you.
Right.
Class action lawsuit. They ended up winning, so it was good, but.
Yeah.
Just
Yeah.
like those strategies that are very, very, or could be too good to be true.
Right.
Sometimes might be.
Yeah.
So,
Yeah. As a general rule, because tax laws change, but if you're in a strategy solely for the benefit of taxes, expect that loophole to close.
Yeah.
You know.
Yeah.
Versus the types of strategies that we're employing here are, using, for instance, a disposal RSP account or an RSP or a TFSA. These are all legal structures that the government created and encourages you to use, and they can reduce your taxes,
Yeah.
right? But when you're setting up some complicated structure, like I'm going to have my money in Bermuda or whatever, at some point, if you're doing something solely to pay less tax, the government will come after you,
Yeah.
right?
You don't want that.
So beware. Value of asset location, I'm going to just skim over all these numbers, but this is the math behind it. And what I can tell you is that placing the right investments in the right accounts adds about 0.5% per year. And that actually adds up over time, right? So being a good investor, having a good process, there's no magic bullet here. There's a lot of little things that you do consistently over time that add up. That's how you invest, right? Income splitting and smoothing. So again, reducing your taxes. If you are a married person, ideally you want your income and your spouse's income to be about the same, okay? Because if I take the simple math and I've got a household where one person makes 100K and the other person makes 0, and you calculate the amount of taxes owing versus another household that's 50,000 apiece, the household with 2 income earners at 50,000 pays far less tax because our tax system is progressive. Higher income means higher tax, right? So what can we do about that? Well, one thing is a disposal loan. So this effectively is if I've got a higher tax person and a lower tax person, I would rather have my investments held in the name of the person who's got a lower tax bracket, because then I can invest at their lower bracket. But you can't just gift the money to them. The CRA will actually come after you in what they call attribution. So it was your money, we're going to attribute any of the income that's earned on it to you. That's what they say. But that doesn't mean you can't loan them the money. This is something wealthy people have done for years, and something that we've automated as part of our service. So if it makes sense for a client, we automate the loan agreement and interest payments. But effectively, you loan it from the higher spouse to the lower. You have to have terms and conditions of the length of time, the interest rates that's being charged. You have to actually pay the interest. The minimum is 2%. And effectively, you do this, you end up with the money held by the lower taxed individual, and then you invest at their bracket to split your income. The other thing is you can do is disposal RSPs. If your income in retirement is expected to be different, you want to use a disposal RSP. Effectively, let's just take John and Jane, and let's say that Jane is the high income earner and John is the low income earner, then Jane can contribute to a disposal RSP in John's name. And then when John takes that money out in retirement, it's now his income taxed at his lower bracket. Okay? So if you've got a discrepancy between tax rates of 2 spouses, there's a couple of strategies to help split and smooth your income.
And correct me if I'm wrong, a few years ago there was income splitting in households and they got rid of that.
Through corporations, yeah. So a lot of people had set up companies explicitly because, I'm a contractor, all the money comes into the company and I'm going to pay my spouse some money to help split my income. That is no longer allowed. So that doesn't mean, again, that you can't loan the money and you can't do a disposal RSP and you can't, structure your investments in a way to reduce and split that income. But you can't do it through a company anymore.
So is that something acknowledged not allowed, and understand that no, but units have position as to any advice, but like, no, I just retain that respect. Wouldn't it be though? Can you still set up a corporation that your spouse works for, and as long as you have some sort of record of that, like if they do like office management or something
Yes.
like that, then that's
Yes.
Could
Yeah, you
kind
just
of-
have to show that the payment is commensurate with the value and the work being done. Yeah, which is totally valid. You can do that, but there's a lot more scrutiny around it than there used to be.
Yeah.
But again, that's a scenario like I talked about earlier of somebody was setting it up solely to reduce their taxes. Eventually enough people do that the government says, well, this is just a tax loophole. We're going to change the rules, right? So if you're doing something just solely to reduce your taxes and for no other reason, expect the laws to change.
Yeah.
Key estate documents. So everybody should have these 3 documents. The first, last will and testament. Effectively, it's just defining how your estate's going to be distributed, so who gets the assets, also who's the executor, so who's looking after things, and if you have kids, who's the guardian, right? So everybody should have a will, everybody should have a power of attorney. What this is if you lack the capacity to make financial decisions, so you're in a coma, terminal illness, and you're towards the end, or you have a permanent and severe mental impairment, then a power of attorney kicks in, somebody helps make financial decision on your behalf. Personal directive, same concept, you lack the capacity, but this person makes personal decisions, primarily healthcare. Do you want to be tube fed? Do you want to be, kept on artificial life support? That sort of decision, okay? So these 3 documents are kind of the core of any estate plan. Everyone should have them. We create them for all of our clients for free. If you're not a client, you can go to a company called legalwills.ca lawdepot.ca, and they will produce these documents for free. You just sign up for a free trial, and then create all your documents, and then cancel your free trial. Hopefully I don't get in trouble for that either. I'm going to perjure myself. All right, conclusion. Why this matters. So there's a lot here, right? So this will help kind of break it down. Why does this all matter? Well, if you just invest, if you're ignorant to all of it and you just go to the bank and get sold a mutual fund, this is likely how you're going to do over 30 years. That seems like a very low number. That's net of tax and net of fees, okay? And with the current low interest rate environment. If you are smarter and you were to invest in index funds, you'd do much better, right? So just cutting the fees adds a lot of value. You should definitely do that. But we also talked about other things. Optimizing with alternatives. Low interest rates, so we want to own high yields, preferred shares, senior loans, mortgages. And on the equity side, it's not just Canadian and US stocks. You want to have some emerging markets and other things to boost the growth. By adding that in, you add a lot of value over time. Other things we talked about, well, you can rebalance your portfolio. So by having your targets, monitoring them, and selling things when they get above target to buy things that get below target, we're effectively buy low, sell high. That adds another 0.5% per year, which is a lot. Over a 30-year span, that 100K, this adds $40,000, right? So it seems like peanuts year over year, but you do it consistently over time and it compounds and it really adds up. Other things, well, you can allocate your investments tax efficiently. Put your emerging market stocks in the TFSA, put your interest-bearing investments in your RSP, put your dividend-producing assets in your taxable account. That adds more value. We can also invest in ETFs versus funds to gain the tax efficiency. That's like the tax deferrals, right? Not paying your capital gains every year because you're buying and holding.
Yeah.
All of these things add value, and you do them consistently with the right process, and you'll outperform. Okay? So then I'll just touch briefly on us. So why did we create this business? I kind of bring it back to Maslow's hierarchy of needs. So basic needs, everybody needs food, shelter, clothing, all that sort of stuff. Okay, great. After you fulfill those, you move on to psychological needs. This is going to be friendships, love, hobbies, things that you want to do. That's all obviously extremely important, but if you don't have the basic needs covered, it's hard to focus on these. And if you don't have both of these covered, it's hard to self-actualize, become the person you were born to be. So what's our purpose here? Well, all of these basic needs can be bought these days. And if you know what you're doing with your money, you've got all of your basic needs covered. So we are basically just sitting at the bottom trying to help fulfill these basic needs both now and in the future so that you can focus on more important things. Okay? A little bit about who we are. So I used to manage $3 billion in assets for high net worth clients. I'm a CFA and registered portfolio manager. The most important thing is that I'm a fiduciary. So I have to act in my client's best interest. If I don't, I lose my CFA. And I worked really hard for that, so I don't want to lose it. So fiduciaries matter. You want somebody who is legally required to act in your best interest. What we offer, well, all of the services we talked about, integrated wealth management, it's all low cost. And then how do we do it? Well, we use systems, right? We automate a lot of it. And that's how we reduce our costs. And we built all that ourselves. Service overview, well, investments, financial planning, tax, and estate are all the buckets that we fill in all the different subcategories, and it's all integrated into what we call wealth management. And that's it.
Thanks, man.
So, if you want more information, our website, you can download the free wealth guide. When you sign up for the newsletter, it just sends you a copy of the guide, and then we write quarterly commentaries. So if you want to stay on top of the markets, then we got you covered there too. We also have, if you have a kid, we have our children's book that we wrote. So it's a children's book. It's catered towards 3 to 8 primarily, and it tries to teach kids the basic habit of saving, just putting a little bit of money away. So if you have kids,
Squirrel, right?
yeah, it's a squirrel one. Yeah, so squirrels have to save nuts for the winter. Yeah. And we offer, if you want, we also offer complimentary plans and estate documents. So if you're not sure, you can basically come to me. We'll create the documents for you for free up front, just to prove that we're smart, hardworking people that you might want to do business with. And if you do, great. If you don't, well, you got a free plan out of it and a free will and power of attorney, personal directive, all that. So, yeah. Questions?
Man, I asked them during.
Yeah.
But yeah, no, I really, really appreciate it. I think this is awesome info.
Yeah. I know it was a lot. So I would recommend download the guide, go over it in detail. If you're on social media, you can also just follow us. We post little tips like twice a week, and then maybe that tip will be something that triggers you at that time, like, oh crap, I gotta, refinance my home, or whatever my tip is that week, so that you're kind of getting the slow drip of actionable items that you can do that over time can put you ahead.
So I guess one question would be, so it's like I've done a bit of reading into like value-based investing, like rule one investing, and kind of more of that aspect, and obviously hearing kind of what you said, that on average, especially retail investors that are doing their own individual stock choices underperform. If you still kind of enjoy that, would you recommend that just have a certain percentage of your portfolio where you can make those choices, that maybe it's a little bit riskier, but still you're not over exposed?
Yeah. So the general idea, just to fill everyone else in, is something called factor investing. So value is a type of investment factor, and the idea is very similar to what Warren Buffett preaches and does, buying companies that sell at a discount in terms of revenue, earnings, book value, cash flows. You buy those cheap companies, then you will outperform over the long term. And that is something that historically has worked, right? And so the question is, well, if I follow a factor like this, because I'm interested in it and I think it works, should I? Well, I think keeping it to a portion of the portfolio is a good idea, right? So maybe that's 10 or 20% of your portfolio that you're kind of playing with. But I do actually believe in factors, but only if they check 3 different criteria. So 1, there needs to be empirical evidence to support it. So if it needs to have worked over a long period of time, right? The second thing is it has to make sense. So there's an indicator called basically the Super Bowl indicator. If an AFC team pre-1980s or something wins, you buy the stock market. And it works 90% of the time, right? But it makes absolutely no sense. It's just data mining, right? You could have enough variables that you run them historically, you'll find something that seems to predict stock market performance, right? But it doesn't make any sense. So you have to have empirical evidence, it has to make sense. And the third one is the hardest one to fulfill, a basis in psychology, okay? So value investing has a basis in psychology. People want to own companies like Tesla because they're sexy, they are the cutting edge, they're self-driving, electric is the future. I get it, right? But because it's all of those things and I really want to own it, I'm more likely to ignore the underlying fundamentals of the business and overpay for it, right? Versus the flip side of that would be Ford. Ford is a boring has-been company. Nobody wants to own it, but fundamentally they make a lot of money and they make a lot of vehicles, right? So if you were to own the value stocks on average over time, you outperform because of that, right? People don't want to own these companies versus they want to own these sexy growth, high new tech firm, whatever, right? So I like value. There's other factors that check those boxes: momentum, basis, and herding, right? Momentum works because we all like to jump on the bandwagon. There's other things. Low volatility works because basically, so low volatility is investing in companies that have lower fluctuations in their price. So think of like utilities companies, fluctuate a lot less than like energy companies. And the reason for that is because they're, well, less risky businesses. Their cash flows and earnings don't change that much. But investors actually prefer, despite all logic, to own the more gambling return type investments, the Bitcoins, the marijuana stocks. They like to own that. The reason is because they like to think about the upside and not worry so much about the downside, right? So they actually pay more for companies that fluctuate. And so low volatility actually works on average, even though it really shouldn't, but it does, because there's a psychological problem for investors that causes us to misprice consistently. Yeah. So factors I'm a believer in. You got to make sure you keep your costs down, still can't, ignore the tax component and all that, and then keep it for diversification purposes to a component of the portfolio, not the whole thing.
Yeah, that makes sense.
Yeah.
Yeah, it's just funny because I remember like when I was in university, I did I got into day trading.
Oh yeah.
So I got into penny stocks at the start. I got lucky.
Yeah.
made a bit of a win, then got into options, like just day trading option contracts, and then at the time I was like, it's your whole chart of like confidence and competence. Like,
Right.
No confidence at all. Super high confidence. I was like, it was a time with heavy quantitative easing. I think it was like September 2012 maybe or something like
Okay,
that.
yeah.
Like Bernanke was just funneling tons of money. I was like, that's just,
Right.
for me that didn't seem possible that I could just keep going. Didn't know anything about economics, and obviously that kept going. And I put a bet on the S&P 500 that it was going to go down. And
Okay.
it just kept. So
Yeah.
I was just like lost all the money. And that's best lesson to learn like at the start is like
Yeah.
I don't know shit.
Yeah. Generally, a lot of these biases, it's easier to see them in other people,
Yeah.
right? You don't see your own overconfidence, but you see it in others.
Yeah.
And the best way to learn is really to invest and lose money,
Yeah,
unfortunately.
honestly,
Yeah. It's the best lesson you can have is that if the very first thing you do as an investor is lose your shirt, you'll be a great investor for the rest of your life because you'll understand.
You're probably not smarter than all of the other, anybody that has a financial
Yeah.
background.
They say the worst thing that can happen to you as an investor is that you buy something and it goes up,
Yeah.
right? Because then suddenly
The first time.
I'm smarter than everyone
Well,
else.
and it's this thing,
I pick the winners
I had
and
a buddy in California that just got lucky with cannabis stocks and then tripled his earnings, and I think he might have even quit his job and started trading. And
Oh, yeah.
I imagine he's not doing that.
Yeah.
So,
The other bias with that is that, so day trading or something like that is one of those events where it's either going to pay off big or you're going to lose everything, basically, right? And guess who you're going to hear from, right? The buddy who won, right? Who bought the next Facebook or whatever, right? They're going to tell you about how they're so smart and I got in early and whatever, right? And then all of a sudden you're like, hey, maybe I can day trade. Meanwhile, all of the people who lost money, because again, it's a zero-sum game. For every winner, there's a loser. The people who lost money don't talk about it. They're embarrassed, right? I've lost money on that stuff early on in my career as well, right? But you learn lessons and it makes you better. But you tend not to talk about it, and so
it is really stupid, but
yeah.
It's, that's awesome. Really, really good. I'm
Yeah.
stoked to go through the guide.
Cool, yeah. Yeah, you can grab my card or brochure if you want. It's got the website on it, so
Yeah.
you can find the guide. You can grab a book if you got like a niece or nephew or friend, or you got your own kids.
I don't-
Grab a book.